Hello, everybody, and welcome to our panel with the long title, Mobilizing Private Equity and Private Credit to Finance Innovation, Technology, and Infrastructure. I am delighted to be joined by two experts in all of those topics, all with insights in all of those topics. To my right, I have Mr. Dimitris Tsitsiragos, who is the chairman of the Alpha Bank Group. But equally importantly, I would say, someone who's been in the business of financing infrastructure and technology and the alleviation of poverty as a member of the IFC for many, many years. So he gives a unique perspective in my mind as bridging the gap between emerging markets and the more advanced economies, and he knows one or two things about lending in the process. Equally delighted to be joined by my colleague and personal friend, Theo Giatrakos. His title, Head of EMEA Alternative Investments, basically means that he runs the private equity coverage team for all the major asset managers for Citigroup in the European market. So his job is to mobilize, actually, private equity and fund it either in the public markets or in the private credit markets, to do all of those things in our long title. So thank you, gentlemen, very much. I'm Apostolos Gkoutzinis. I am an international lawyer in London, and I work in the financial markets, also including in Greece. So I will be moderating this panel. You'll allow me to set the scene first, maybe for 30 seconds, so that we can flow from there. Private equity and private credit, two asset classes that are relatively new in the sense of the growth that they have experienced and the importance that they have acquired in the financial system. I think still, as part of the overall economy, I would think that the minority of GDP and the minority of jobs are being created or are being managed by these funds. Last statistic is something around 10%, perhaps in the US, maybe 7% of GDP in the UK, in terms of contribution of the broader private equity industry. But still, in absolute terms, we're talking about trillions of dollars of assets under management and equal amounts of dry powder to be deployed. So we have commitments by the limited partners in these funds that are ready to be deployed in an unprecedented growth of these two asset classes. At the same time, we have to finance technology and innovation and investments in infrastructure, again, at unprecedented levels, as the world is moving into new phases. And in as much as innovative ideas are behind technology and innovation, most technology entrepreneurs will know that after the initial idea and after the hard work that goes behind these innovations, the stark reality is they need to raise the finance and the capital to make them happen. So that is the overall context. I want to start with Theo. And Theo, having set the scene a bit, would like you to talk to us about the trends right now in the private equity industry as you see them, and also how all of that can be relevant for Greece as is looking to attract as much capital as possible.
Sure. Look, thank you very much, first of all. Thank you, Apostolos, for moderating the panel, and thank you to Delphi Economic Forum for giving us the opportunity today. Big question, right? I mean, and there is a lot of topics, so let me pick it up. I'd say, first of all, the private equity ecosystem right now is clear at an inflection point, at a point where it's going to transform itself over the next 10 or 20 years. You spoke about private equity and private credit. I'm going to say that we already have part of this industry where the line between equity and credit is almost blurred, where basically you have some of the biggest global diversified asset managers, the Apollos, KKRs, Blackstones of this world, and there is more, I don't want to be unfair to anybody, where your availability and fungibility to play across the capital spectrum is phenomenal, and where they have significant fundraising abilities to raise capital with appetite to generate returns at the right level in this spectrum. And you're going to see that through the cycle, this return equation changes and shifts. But let's speak about what we call private equity first, right? I mean, by private equity, we mean, let's call it the traditional buyout business, right? I mean, what we grew up to work with in the 80s and the 90s. 2 or 3 big observations, right, about private equity. Number one, it's a much bigger industry. It's a much bigger industry, much more diversified industry than it used to be. The amount of dry powder, as they call it, the amount of capital available to them is impressive. Different estimates, you can estimate it's at $5 trillion, $6 trillion outstanding, but in any event, it's a humongous amount. And we're going to get to a bit to how they look at opportunity, but right now you're seeing private equity being at the slowest pace of deployment as a percentage of the dry powder. Through the cycle, you expect that on an annual basis, the global private equity firms deploy around 30% of the outstanding dry powder per year. Okay, probably high 20s to 30%, which probably means that it takes you between 3 to 4 years to deploy your fund, and then you gotta wait in order to exit and monetize. This figure now has actually dropped below 20%, and there are reasons for that. So think about private equity, very liquid, lots of resources, and scarcity of opportunities, not enough good opportunities out there. I'd say the second point is it's a tough job, right? I mean, private equity investing is a very tough job, and this is also why it's so commensurate as well. But it's also fair to say that the last 2-3 years, it's a tougher job than it was 7 or 8 years ago. And that's, again, a function of a number of different factors. Higher rates, okay? It's at the heart of that. Now, private equity is not just about financing, it's not about just credit, it's not about leveraging your business, it's about a bunch of other things. But let's face it, the fact that they can accomplish extraordinary returns is a lot about the fact that they have this unique talent to be able to acquire business and lever them to the hilt, and in this way, turbocharging the returns on equity. Also, it's tougher because, again, we talk about size, they target bigger businesses. Bigger is better, clearly. It's tougher to exit. It's tougher to monetize. All of those guys are in the business of buying and selling companies. And if you buy something today for $10 or $15 billion, as we see a number of deals across Europe, you gotta propel it to a $20+ billion valuation at your exit. How do you exit this? How many sponsors are there who can actually afford to buy this? Are there strategic buyers for your portfolio company? If the answer to both is actually difficult, okay, you got to IPO your company. What does it leave you with? You got a obviously very volatile and cyclical IPO market. I mean, equity capital markets. I mean, everybody knows very cyclical. And then once you IPO it, you still probably have to do 7, 8, 10 sell downs of your participation in order to get to a full monetization. So more challenging times. Now, you talk about Greece, and we should go into a bit, kind of peeling the onion of how people are looking at Greece. I mean, it's an understatement to say that private equity right now is more interested in Greece than it was 6 or 7 years ago. I mean, it's obviously, it's been a game changer. They look at this country and they see a fascinating economy. They see stability. They see growth. They see a country of spenders, not savers. So all of the features are there. But private equity doesn't, wake up one morning and say, hey, you know what, guys, we need to buy something in Greece, or we need to buy, something in Sweden. They look for good businesses, strong fundamentals, strong management teams, and what they call a private equity thesis. And they also look, because these guys, they don't have a crystal ball. They're not getting paid to predict the future, with precision. They will admit they're often wrong, and they're wrong a lot, right? So you actually need to underwrite something that has enough backstops in order to protect your downside, and in order to actually forecast what's going to happen if events go the wrong way, because usually they do go the wrong way.
I'll come back to that a little later, Theodore, but I would like now to turn to the chairman. I mean, obviously, you are the chairperson of one of the largest banks in Greece, one of the 4 systemic banks, with an illustrious history and also a critical role in virtually every aspect of what is bankable in the Greek economy. One cannot think of any particular sector in which your institution and your peers don't play a role. Why can you talk to us a little bit about your perspective? First of all, I mean, picking from where Theo left it in terms of the Greek economy becoming a more attractive destination, perhaps for private equity. How do you see the macro and the investment climate in Greece as an initial introduction, and then perhaps what Alpha Bank is doing, to accelerate that as much as possible as a private actor, but at the same time take advantage of it for the benefit of its shareholders and its stakeholders at large.
Thank you. Thanks to Theo as well. Thanks, Apostolos. Thanks to the organizers for the invitation. Actually, it's on a personal note, it's very nice to be back here in the 10th year anniversary of the event. I was here at the first event as an IFC representative. And as you talk about Greece becoming a more attractive investment destination, the ones who were here 10 years ago remember very different Greece, very different times. So I think the key message here is when we also want to talk about private equity and private credit looking at Greece, is Greece's investment climate today and Greece's position in the global economy and the European economy and the markets today. And I think the key element here is that Greece today has earned again the confidence of the markets and the confidence of investors. And this is key. If you look at the numbers, and I will paraphrase some of the things we heard from our Bank of Greece governor a few days ago, Greece grew, last year GDP grew at around 2.3%, which was the same as GDP growth in the year before. It's one of the highest rates in Europe. The most positive thing about growth in Greece in the last years, and I think the governor said it very well, since 2019, investment in Greece has been growing. And as part of this investment growth has allowed the country to cover some of the investment gap that we face and we've been facing since the crisis. Average investment per GDP in Europe is around 22%. In Greece today, we're at around 15–16%. In the depths of the crisis, we're at 11%. And this investment has been growing. But the key element, and the governor flagged this one, is the nature of investment is very different. Before the crisis, 2007, 2008, I think 4/5 of the investment was going towards residential housing, and the balance was going to productive investment. Today, the situation has been reversed. The bulk of the investment is going to productive investment, which allows Greece to develop a new productivity model, and I think make Greece more competitive. And I think that's a big plus, and that makes Greece more attractive for private equity investors. I will leave private credit separately. We will discuss about it. We'll talk about it a little bit later. I think the second thing is, I mean, in my old job, we used to talk about the investment climate. And if you look at one, as an investor, one looks at what has happened in Greece in the last, say, 6–7 years, the change is quite significant. That doesn't mean that things have, we've solved all our problems. A lot more has to be done. And I think one of the good things is, the Deputy Prime Minister made a number of announcements about the areas that he wants to focus on and the areas that he wants to address in terms of reforms being continued and making the country a more attractive investment destination. I think from our perspective, what we look, and I think also from local, the Greek investors, but also foreign investors, we need to still work on simplifying the bureaucracy in Greece, eliminating a lot of the procedures, speeding up the approval process. We need to work on judiciary, and we need to work on the administration of justice to make it faster. We need to simplify the tax system in Greece a number of things that are also priorities of the government. The government has worked on it.
To wit, a few things have not changed since 2015, because back then we were talking about the same issues, the administration of justice and the bureaucracy.
Well, I think the Greece today is, I mean, let's be fair. Yes, we talk about the same things. I mean, there are things that are problems of the country, but today Greece is a much more digital country than it used to be in 2015. I think if you look at what happens in terms of like partly as capital controls, but partly as the wage changes, I think Vasilis is here and Lazarus will correct me. I think we do like more than 90% of the transactions in the system are done electronically. This was not the situation in the past. Banking transactions are done electronically. I think, you know, as I talked, the nature of the investment is very different than what it used to be. I'm not saying we've solved all our problems, but we have to do a lot more. And I think it's reflected on the levels of growth we have in the country. I think we as Alpha, I mean, we are at the forefront of this effort to help the growth in Greece remain sustainable, to help support Greek entrepreneurs, and to help also support foreign investors coming into Greece, including private equity investors. I think from our perspective, I mean, our loan book has been growing steadily in recent years. I mean, we had a record year last year in terms of loan growth. The other thing we've been doing is we're at the forefront of leading infrastructure investments in Greece. And in doing so, we've worked with a number of large asset managers. You know, like Heinz comes to mind. You know, we financed the airport, where we have the Canadian pension funds there. We've done a lot of work with also Macquarie, who is in Greece. So this is a vote of confidence in the country. At the same time, I mean, what we're working on is with our partners, you know, looking at being historically the bank of entrepreneurship, the bank of innovation. We want to help our existing Greek clients become globally competitive. And I mean, when I look at my past life as a development banker, and I think is for Greece to grow, for Greek enterprises to grow, we need to look at the world as a market. We don't need to look only as Greece, but as a world, as a market. And extroversion is something that we find as Alpha Bank very, very important. And in that respect, I think a big plus for us is our partnership with UniCredit and our existing relationship with UniCredit, as you know, as a shareholder. Through UniCredit, we're introducing new financing tools in the market for the Greek corporates, but we're also opening new avenues for the Greek corporates because the Greek banks withdrew from a number of international destinations. We now joining up forces with UniCredit. We're giving them a channel to help their businesses grow into Central and Eastern Europe, and also more globally. So I think that is extroversion is something that we push very much as Alpha. We also want to support innovation, and I think some of the elements of that the private equity brings to the table are also some of the elements that a systemic bank in Greece brings to the table. I think I was in another panel, and somebody put it very nicely, another banker, I think I know who it is, talked about the role we as banks playing in helping taking, 93% of enterprises in Greece are small enterprises, and helping grow these small enterprises into becoming more institutions, building corporate governance, thinking of succession planning. And in that respect, one of the ideas, and also building critical mass. So in that respect, one of the recent acquisitions we announced, with Axia, is an effort in that direction, is to have better investment banking capability, we at Alpha, so that we can help our clients.
You're making a very good point. Often people forget that for small and medium-sized enterprises that are growing in an economy, the first port of call for improving governance, improving functions, improving behavior internally, improving succession plans, is the commercial bank. It's not the IPO market. It's not a private equity fund. You are the first ones to go there and say, you have to change this, you have to change that, you need to be better at that. So I think what you say makes a lot of sense in a financial system as the Greek one, which is predominantly dominated by the big commercial banks. You have a role to play as an incubator, I would say, of small business talent that perhaps can grow over time into the hands of the local and, why not, the international private equity community. We can come back to that, but I don't know if you would agree with that.
No, I think I see it very much as a role. I think is maybe it's my bias as development banker, but I think is banks in Greece and in a country like Greece, they have a social role to play. And I think our role is to help build capacity and help build champions. And I think that's the objective of Alpha, but this is the history of Alpha as well.
Thank you very much. Theo, coming back to you and your international hat, I mean, one of the themes of our panel is infrastructure. A lot of the alternative asset managers that you work for, some of the largest ones, they have multiple strategies, including, of course, infrastructure. I have two practical questions for you. One is, what are the maybe one or two mega trends that are happening right now in the world that perhaps we don't know about or we don't know enough about, that some of the smart guys that you work with are financing right now that we'll see perhaps in a few years? What are the exciting new things in the broader technology and infrastructure space? And then more specifically with Greece and infrastructure and your clients, where do you see the opportunities? Where do you see the trends?
Absolutely. Look, so to your first point, I think it's pretty clear. It's artificial intelligence and the need for digital infrastructure. That's a mega theme more than any other theme right now. And again, think about all of those asset managers as this is driving their multi-strategy approach. If you read Blackstone's annual report or their investor presentations, AI and digital infra is core to any of their strategies. The private equity business is buying businesses that actually offer services to data centers. The real estate business, which is the largest business of Blackstone, is buying land for new data centers that will be required for deploying AI. So I think there is nothing coming close to that. Digital infra, lots of white space in Greece, no doubt about it. And I think also about businesses surrounding digital infra. It doesn't need to be just owning the data center, just owning the grid. How actually do you service this industry? How do you commercialize all the data you get out of this big trend? Now, Greece and infrastructure, I mean, very long tradition, very long track record. The chairman spoke about PSP and Athens Airport. I mean, it's multi-strategy. But I would say two or three things. What are infrastructure investors after? When they look at a country, they look at stability. Take for Greece. They look at a strong banking sector, okay? Because especially for infrastructure investors, with lower returns, your ability to get the right capital structure is even more critical. I keep, one of the things that I keep hearing from investors who come to Greece for the first time is, well, two things. One is super strong management teams. People are surprised by the quality of the management teams they find here. And second is they're saying we're seeing actually very resourceful and agile banking environment in terms of being able to provide, leverage financing, infrastructure type of financing, and very competitive. I'm not suggesting you increase prices, but lots of compliments on that. So I think the sort of macro, the sort of general landscape is helpful. The one thing I would actually put out there, which probably we're not thinking about it enough in Greece, is we think about infrastructure as buying airports, for example. And I remember when we were privatizing the Greek airports, and IFC was there as well. Motorways, maybe some sort of utility infrastructure. And this is what we actually call, this is like core infrastructure. The infrastructure community, however, has expanded significantly to what they call core plus, and basically looking for other sectors where you have, the features of infra investments, resilience, some sort of regulatory framework, or if you don't have a regulatory framework, you got, long contracts, visible cash flows, and ideally some sort of, anti-inflationary protection. And this is why you see infrastructure investors spending money in education, environmental services, smart metering businesses, waste management, even lotteries, across the world are owned by infrastructure. Probably the largest infrastructure deal of 2021, if you think about this as a sort of a bit of a peak of the cycle year, was Refresco, which is the biggest plastic bottler in the world. So think about this, like a plastic bottler a very anti-ESG material simply because of the longevity of the contracts and the fact that they took a view and said, look, we've got all of these big corporate customers around the world. They cannot operate without our bottles. Yeah, that's an infrastructure investment. So that's what I would actually put out there. And I'd say that away from just concessions and state-owned utilities, there is a bunch of private-owned businesses that could actually tick a lot of the criteria for infrastructure investors.
I think Theo makes some excellent points, and these are some points that we have been discussing internally as well. And I call some of these things core, or you call it core or plus infrastructure.
Yeah.
I think of it, some of it is the social infrastructure, and you see a lot of private equity investors going into education, going into health. I think here in a country that is, depends heavily on tourism, we can look at the infrastructure around tourism. And you talked about some of the things that, when we talk about the investment climate in Greece, some things that maybe need further improvement, and that's, I know it's something that's also on the agenda of the government. We have a PPP regime in place. It's a PPP regime that we can make it better. We can make it more attractive. But I think if we think at infrastructure not as not the traditional infrastructure, roads and motorways and ports, and roads, ports and airports, and power, where everybody is very active. But we look at these areas that can improve services in Greece. That, I think, is an opportunity for investment, and it's an opportunity also to build new businesses in Greece.
One controversial question is coming. I don't know who wants to take it. Are there any sectors of the economy, either hardcore utilities or issues of, national, perhaps areas where they are adjacent to national security or similar areas of infrastructure where you feel that a financial investor with a short-term horizon to make money and exit may not be an appropriate investor? Would you exclude any parts of the economy from, I don't know who wants to pick that, from that? And on,
I cannot think of any, but I don't know. Do you?
Look, I think the you always find mitigants. So if you want to do a deal, you're going to. I mean, again, I go back to we privatized the regional airports of Greece in a very, very, very tough environment, and you had real investor interest, and there was a national security issue because some of them have military use or joint use, civil, and you find mitigants. So these guys are clever guys, and they come up with solutions. I'd say there is possibly, we've seen in certain jurisdictions of Europe, take Poland for example, take Hungary, where it wasn't really kind of the nature of the business, but it was more, again, goes back to government stability, and where there was a big risk, which is a binary risk, of nationalization of those businesses. So that's something they cannot take. But as soon as you actually convince them of the government stability and continuity of government, you're okay. The other thing that a lot of investors are very sensitive to is reputational risk and any kind of other social sensitivities. There are investors who just don't invest in healthcare services because there is a human element attached to it. There is all kind of reputational litigational issues that they don't want to associate themselves with. Same goes with education, and especially, when actually you talk about kind of, what you call the K-12 or basically, junior education. But that's probably the bigger social element rather than, I think people by now are pretty experienced in dealing with a number of those.
Mr. Chairman, one area we have on the slide, but we haven't covered, and again, maybe it's going to be controversial. Pretend your CEO isn't here. I want to ask you about sort of the direct lending or the credit fund kind of surge. We are seeing not in Greece yet, but we're seeing a lot in Western Europe, all these alternative asset managers that we talked about. I mean, they are raising enormous credit funds with a clear strategy to fill in the gap that is either left on the left from the capital markets and on the right from the commercial banking systems in the relevant countries. I mean, clearly Greece has a commercial bank-dominated financial system, and that's not going to change, not in our lifetimes. But still, do you see any complementary role for any capital structure for these alternative credit providers to compete or perhaps play a complementary role with you?
Well, thanks. I think you used a very nice word for it. I think in Greece, private credit is complementary at this stage. I think there's enough liquidity in the system, and it's a bit of a supply and demand. which is a bit different than Europe and different than North America. And I think it also reflects something that we have in Greece. You know, when I think about the challenges we have in Greece and some things we could do is we can deepen the capital markets, okay? We can develop a deeper, you have developed, to develop the capital markets and deepen the investor base. Abroad, insurance companies look for alternatives, you know, investment and investor products. I mean, we're not there yet in Greece because we don't have such a demand. Eventually, we could get there. But in today's Greece, I think, and Theo, since he covers the space and he might have a different view, I see private credit players, asset managers, as complementary. And I think some of them have already been in Greece because a number of the alternatives players came in Greece and took some of the distressed assets. I mean, that was that's the one area we have, you know, we saw alternative investors, private credit coming into the country. I think also something that the banks don't do in Greece, and part of it is because of regulation, part of it is because of risk aversion, is in infrastructure space. What you see in other jurisdictions is you see mezzanine structures and preferred equity type of structures. Yeah. I have not seen that in Greece yet. Oh, yeah. Alternative, you know, private credit players can come and cover that space. Pricing in Greece is doesn't necessarily going to be very attractive, but I do think there is a room for that there. And that's something we could do as a bank as well. I think more than that, I mean, securitizations. We've done a number of securitizations. A number of players in Greece have done securitizations, like shipping is the one that comes to mind, where private credit players can be partners for the banks in these activities. So complementary role is, complementary is the right word for private credit today in Greece. I think if the market grows, potentially we might find opportunities for private credit.
Yeah, that's fantastic. Very well said. I mean,
I think it's very well said. And that's all that we had time for. So thank you very much.
Thank you.